Oh, okay. All right. I think we may have some technical difficulties worked out, but welcome to our first Q&A live stream of 2023. This might be a smaller group than we usually have. I was sick for the last couple days, and usually I do my promotion on Monday or Tuesday to give people a little bit of time, but I sent out my reminder email just a little bit late this week. So anyhow, it might be a little bit more of an intimate group, but I do know that a lot of people watch these things later. And so hopefully, what I can do is just give people some relevant tax information and answer the questions that come in. So don't be shy about putting questions in the chat. I will be monitoring those questions and I will get to them kind of in the order that I end up receiving them. But it's January 11th. We just finished up a few months of tax planning. A lot of tax planning phone calls. We recorded a lot of videos centered around tax planning and a lot of questions. So Prosperity Society is definitely going to have more and more content that's being added to the platform. Hopefully, a lot of you guys are finding that stuff valuable. But I'm just going to kind of jump into it. I mean, we got tax season coming up. The relevant things that are right in front of us most immediately would be fourth quarter estimated payments, which are due on the 17th, next Tuesday. And then by the end of the month, we have 1099 preparation that needs to be done and mailed out. So, there are some people who are getting us their tax stuff already, which is great. But a lot of the software updates aren't done yet, and the IRS is not open for e-filing. So, we're just kind of putting work papers together and making sure that everybody kind of has their ducks in a row for some of that stuff. And then probably in 2 or 3 weeks is when we will start to hit tax season really hard. So that's a little bit about us. That's what we've got going on right now. And I'm just going to jump into it. I'm going to start answering some questions. Ray is one of my guys that loads us up with questions, and they're always really good. And I know if you're investing in real estate, then his questions are definitely going to be pertinent to you. All right, so first question is, what are the interest write-offs, mortgage limitations if you purchase and finance a second home to vacation in? All right, so the 2018 tax plan kind of changed what we were allowed to do when it came to the mortgage interest deduction. And just as a little bit of baseline on this, the mortgage interest deduction is an itemized deduction. So if you own a house and you pay interest, in most cases you're going to be able to deduct that interest on your Schedule A if you itemize your deductions. Now, one of the things that they kind of put into place maybe to kind of limit people from taking too much of a mortgage interest deduction is that they reduced the loan balance that you're allowed to have outstanding. So in the past, you used to be able to have up to $1 million of home indebtedness. Now you can have $750,000 of home indebtedness to be able to take a mortgage interest deduction on. So specifically with your question, if you have a first home, and let's just say, for example, you have a $750,000 mortgage on that house, you will be able to write off the interest for that home. Now, if you have 2 homes and one of them has $750,000 and the other one is $500,000, then the mortgage interest on the $500,000 kind of vacation home, the second home, will not be deducted. So that's just something to look out for. I mean, what a lot of people do is they kind of play with those numbers. They want to make sure that their total, indebtedness is less than $750,000. So, maybe they'll put a chunk of money down to make that happen, or maybe they'll end up, paying off the first house and then getting another one. There's just a couple different things that people would do. So, that's kind of what to look out for on that. I mean, that is a change. If somebody does have $1 million of debt, then we have to take a percentage. So, 750 out of $1 million is 75%. So if you paid $40,000 of mortgage interest, $30,000 would be deductible. The other $10,000 would be non-deductible. So just something to look out for on that. All right, let's see. I have a self-directed Roth IRA account, and the custodian allows me to pay the service fees with non-IRA funds. Can I write these service fees off somewhere in the 1040 Schedule A as an itemized deduction? Unfortunately, no on that. There used to be a 2% threshold for certain itemized deductions like investment fees. Which would be something that this would fall under. And, if the investment fees exceeded 2% of your income, then you would be able to take it as an itemized deduction. But again, that 2018 tax law, what they ended up doing was just doubling the standard deduction and then limiting some of the itemized deductions. So that was one of the things that kind of fell by the wayside, is certain investment type fees like that. Now, if you had, let's just say, this kind of maybe goes back to the first question too, but, let's say you have some kind of rental component. Let's say you get that second property and you're using it as a rental. Well, when we have rental income, then that $750,000 rule kind of goes out the window. So, some people who do get second homes and that sort of thing, what they try to do is maybe turn it into, maybe it's a short-term rental where they're on Airbnb or VRBO or something like that. That way it kind of moves that second property to a Schedule E situation where that $750,000 thing doesn't really apply. Now, maybe if you're self-directed Roth, maybe ended up being involved in more rental type stuff. Depending on your setup, maybe there could be some kind of way that we could squeeze that in, but maybe not too, because when it is a Roth, everything kind of runs through its own kind of P&L on the Roth side. So I would say for part one, I think my point about maybe turning it into a rental is good. In point number two, you're probably not going to be able to figure out a way to get that service fee done kind of either way. But I felt like that was probably worth mentioning. All right, if I purchase a real estate property using self-directed IRA, what are some of the prohibited transaction rules? For example, I do not believe that I'm allowed to personally do any work on the property. Yeah, so, prohibited transactions, that is definitely well, let me just give a little background, actually. We're talking about self-directed Roth IRAs and IRAs. There may be some people that are kind of like, well, what's this self-directed IRA thing? And, what Ray's talking about here, just for the general, people who are watching this, is a lot of times we have our IRAs and they're sitting with a custodian, and maybe somebody like our financial advisor is trading stocks with it. What some administrators will do is allow the person to self-direct that and invest it in whatever they want. And so you'd be able to maybe just go buy a property. And a lot of people like to kind of use their self-directed IRAs to be able to do this. Maybe they want to do one flip per year, or maybe they want to, just acquire rental properties or buy land and just hold it. Like I've seen that a lot, where people buy a big piece of land and just sit on it. So having that self-directed IRA is kind of cool, because if you're going to sit on something for a long time, especially if it's a Roth IRA, in the future, you may be able to sell it and have a big, not pay any capital gains or anything like that, because it's in your Roth IRA. Now, that sounds really good, and it is really good if you can do that. But what ends up happening is the IRS doesn't want people just setting up one of these self-directed IRAs and then just essentially running a business through it. And so what Ray's kind of talking about here is these prohibited transaction rules that are out there. Is if you do have real estate that is in a self-directed IRA, there's certain things that you're not necessarily allowed to do. And so some of the prohibited transactions, and he brought up one of them, is essentially working on the property personally. So you really draw, when you invest with your Roth IRA, you really kind of draw a line in the sand between you and the Roth IRA. So something like providing, like let's say it's a rental property and a toilet breaks. You're actually not allowed to go fix that toilet for the tenant. You have to have a third party or a management company who is handling that, because you'd be considered a disqualified person. You would not be able to lend credit or give money to your Roth IRA. That's something that's disqualified. A couple other things that I would say they use here, like we'll say you deal with the plan income or assets in your own interests. Now that's a pretty broad one. And it makes it a little bit tough to deal with. But like what I always suggest with everybody when it comes to some of these prohibited transactions is don't work with a rinky-dink self-directed IRA company. You want to work with somebody who's legit and really kind of understands some of these things, because if you do that, if you get into prohibited transactions, you could get penalized big time by the IRS on that. So, you're not allowed to use these plan assets as a direct benefit to yourself. And so acting in your own interests, working on it yourself, lending money, paying for things. The plan has to pay for the stuff. So, again, like if the toilet breaks, you can't give cash to have somebody go fix it yourself. Your Roth IRA would have to be the one to pay for it. So, those are just a few things to kind of watch out for on some of that. All right, let's see. What else do we got going here? Ray is also wanting to have a little conversation about opportunity zones. Now, opportunity zones is something that came out of the 2018 tax plan as well. And this is really interesting. To me, this was a very, very interesting idea. And the idea behind this was that the U.S. government ended up identifying about, it's a ton of different places, but they went to all the places around the country that really need investment. So a lot of times it's like your worst neighborhoods. So, pick a city, look at the worst neighborhood. It likely is an opportunity zone. And essentially what these opportunity zones maybe you've heard it as like a QOF, a Qualified Opportunity Fund, something like that. But essentially what ended up happening here is to promote investment in these certain areas, because the worst neighborhoods aren't always going to be getting the most investment dollars. A lot of that stuff's going to the newer, nicer neighborhoods. But they ended up doing a trade-off. Essentially, the biggest pro of a Qualified Opportunity Fund is that you'd be able to take capital gain money that you have. Let's say you sold a property and you made a $100,000 gain. You're like, man, I really just don't want to pay $100,000 in taxes. The Qualified Opportunity says, if you end up putting that $100,000 gain and you invested in, I don't know, a little duplex in what's considered an opportunity zone, if you invest in it, leave your money there, and basically make this neighborhood better, then what we'll do is we'll allow you to defer that capital gain. Now, depending on how long you have it in, is kind of the benefit that you end up receiving. So you could defer. I have to double check the rules, but I think if it's like if you had it in there for 7 years, you can defer 80% of your gain. If you held it in there for 10 years, then you can defer 100% of the capital gain, not pay any capital gain. So this really pushed billions and billions of dollars into neighborhoods that really needed it. And so what's the biggest pro is that you'd be able to defer your capital gains. The biggest con, I would say, is that if you see it as one, but the biggest con would just be that you have to put your 100,000 in maybe the neighborhood that you don't necessarily want to put it into. A lot of times, if you have $100,000 to invest and you could put it into a nice neighborhood or a bad neighborhood, you'd probably go to the nice neighborhood. You have a better chance of upside on something like that. But if you run some numbers and you figure in, if I have $100,000 gain, I mean, I would probably pay about $20,000 in taxes if I just accepted it, or I could move the 100,000 into something else. If the numbers pencil out, then maybe an opportunity zone's the way to go. But there is some compliance that goes along with it. You have to file some forms and let the IRS know what you're doing and that sort of stuff. But I think I've had clients who have been really happy with opportunity zones. If you're developing, if you're doing a project and you're doing something in an opportunity zone, I think it could be maybe easier to get some investor money. So you find people who have lingering capital gains and bring them into a project that you're working on. So there's some different factors there that I think kind of make sense on some of that. All right. Keep the questions coming if there's more questions, if there's follow-up questions. Hopefully some of that stuff is helpful. I did want to engage a little bit in 1099 prep and some of the ins and outs of doing 1099 work. What we do in our firm is we grab a software and we send an email out to all our clients that say, hey, get your books ready, get them up to date, let us know who your independent people are. The most important thing and tip that I could give is to not pay anybody unless they give you a W-9. Far too often at this time of year, hey, I paid somebody, but this guy never even respond. He won't respond to me. He won't give me his social. I don't even know where he lives. I had to pay him cash. That kind of stuff. The IRS is not going to allow those kinds of deductions. That is the reason that they do 1099s, is so they know who's being paid what. I don't think I actually picked up this tip until somebody did it with me. Is they said, hey, we'll issue your check as soon as you send me your W-9. And I'm like, well, I'm an S corporation. Don't worry about it, because S corporations are exempt from 1099s. And they were like, we still want your W-9. So they were pretty firm on just saying, we need your W-9. Just so you guys know, I have a W-9 on my desktop now. Just because it's like, okay, I'll just drag it to this email and send it to him. But that is a good standard business process where you're just like, you know what? If I have a plumber, a roofer, anybody that's doing work on my properties, and I'm paying them over $600, I need a W-9 off of them. And so that's pro tip number one right there, would just be just collect W-9s. I just had a company that sent me their 1099 stuff in. I sent out the email to all my clients the other day. They had it to me within a day. They gave me a list of how much they paid everybody, and then everyone's W-9 was attached. Really simple and easy process. Excuse me. But yeah. So, anyways, that is definitely a pro tip. What we do is we e-file, and we'll e-file and mail them out to our clients. Hey, we grab me a drink of water. Excuse me, I'm getting over a little cold, but anyhow, what we do is we e-file for everybody. We mail out to all the recipients. So really all our clients need to do is just kind of pull together that information. And I realize that that's kind of the hard part at times. It's just pulling together that information. But in the moments where you're just like, okay, I have all the W-9s together. All I really need to do is figure out how much I need to pay somebody and how much I paid them throughout the year. Now, if you have a good bookkeeper like Marie Pews, who's on this call, she's likely all over this type of stuff for you already. Probably could just generate a report right out of QuickBooks for you, and takes care of all of it. And as a CPA, I'm gonna say, we don't earn our living off of 1099 prep. We love when the bookkeepers are on the ball and have all that information together. So, pro tip number 2 would be, have a really competent bookkeeper that just is on the ball for you and kind of taking care of a lot of that stuff. But in the case that you're kind of, doing your own thing and that sort of thing, we have a lot of clients who are like that, where we issue a couple 1099s for each year. And, this is kind of our process. So over the next 2 weeks, what we'll do is we'll just collect everybody's information. And then we usually spend, about 4 or 5 days just entering everything into our software, reviewing it, checking it. Then we stuff envelopes, e-file them, and mail them out to all the clients. So, the rules are that they have to be mailed out by the end of the month. And, people start expecting it at that point. So, there are some exceptions to 1099s. If you're an S or a C Corp, you don't have to issue 1099s. If you pay an S Corp or a C Corp, you don't have to issue 1099s to them. If you pay somebody by credit card, let's say, then usually they will receive a 1099K, and so there's some exception there as well. So, if you have any questions about, who needs a 1099, the most common one would be a 1099 NEC, non-employee compensation. This is just an independent contractor that you paid over $600 to. A lot of times that's maybe a bookkeeper, maybe it would be your office cleaner. If you're into rentals, it might be a property manager. It might be, somebody that is doing repairs for all your properties. Those are the types of things that, usually you would have one for. If you have a C corporation with a shareholder loan, or an S Corp for that matter, we would want to make sure to do 1099 interest forms. If you have a C corporation that you've taken a dividend out of, we would do a 1099 div for that. And those are probably the ones that we see the most. Property management usually sends out 1099s for rents. We see those quite a bit. But that is going to be the overwhelming majority of 1099 prep and kind of what we're focused and working on. Al, thanks for dropping in the chat there, buddy. You are correct. A significant con of a qualified opportunity zone is your age. If time's ticking and, let's just say, for example, if you're 70 years old, you might not want to wait 10 years to save 20K. Like in that example that I gave where you have a $100,000 gain, maybe you just swallow the pride and you stroke the $20,000 check to the IRS because it's not worth waiting till you're 80 years old to save 20K. Maybe you just want to have the $80,000 of liquidity and do whatever you want. That's a really valuable point. Thank you for adding that. All right, I'm going to talk a little bit about tax season too. I have numbers on this. I keep track of how long it takes for us to complete everybody's tax returns from the time that they turn it in until the time we file it. Now, what I always do is I try to tell people, like, get your stuff into me as soon as possible, because the earlier we get it in tax season, the quicker turnaround time we have. So I have kind of figured out that when I receive stuff between January 15th and February 7th, our turnaround time is usually around 7 days on average. We could turn it around pretty quick. E-filing will open probably around the 25th of January, but after that 25th, when we could start filing, anybody who turns their stuff in kind of in the first 2-3 weeks of tax season, they get their stuff turned around 7 to 10 days, and sometimes even quicker than that. Now, here's where, and this is going to be all accountants in general. I keep track of the numbers, but this is my colleagues as well. But once people start turning their stuff in end of February, early March, that is when the fire hose just hits us. I mean, we'll get 100 returns in all at the same time, and it's all right in that February-March window. And so what ends up happening is we usually spend like the whole month of March just figuring out and just going through the list. And, for some people, they get a little frustrated by it. They don't kind of understand that. But, I want to just give tax season pro tips. But, like, if you're the type of person that's a little bit anal about how fast your turnaround time is on tax prep, make sure that you're in right in the beginning. And that's a pro tip for you guys, because we aren't stressed out yet. We're not worn out yet. We are on our game. We've just basically spent like the last kind of like month or so kind of recharging, getting ready for tax season. And so when we get, these returns in the end of January, early February, we're like kind of ready to rock and roll. And you kind of have, our attention because, we haven't gotten 100 returns yet. And so, I kind of want to throw that out there because I would like to pull in a little bit more of my work in the end of January, early February. And so, where I'm going with that is, work with your accountants when, they're not under duress. When you're under duress, you're more likely to kind of make a mistake. Now, a lot of accountants have processes in place to catch mistakes and things like that, but, we're not perfect. So, that's a pro tip is, the earlier you get in, the better. So, spend the next 2 weeks kind of getting that stuff together. If you're somebody that normally files on time, think I'm going to get my guy, the stuff in the first week of February instead of the first week of March. Now, the other thing that I'll end up saying is if you expect to be done by April 15th, I would not turn in the stuff April 1st. You're going to want to have that stuff in a lot earlier than that because, again, you're kind of working against, accountants that have received a lot of returns, and we kind of just are first in, first out. So, kind of pay attention to that. Pay attention to when you're giving your stuff. I would also say don't be too scared of an extension. Extensions are not a scary thing. I filed an extension of my own stuff last year. They're not a scary thing, and you're really not penalized unless you owe tax. So, something that's a little bit interesting is sometimes people will think, well, I'll just file an extension, I'll pay my taxes later. Well, you get a 1% a month penalty on that. So, that's kind of no fun. But if you do better than 1% a month with your money, then maybe you don't want to give it to the government. What I would say on that is if you're the type of person that's like, hey, I'm okay with filing an extension. I know I need to file an extension to get more of my stuff together. What I would always tell everybody is, cool, well, let us kind of project out what your income is. We can make an extension payment if you want to make an extension payment. That'll make it to where you don't get penalized, and then we'll get all the time in the world over the next 6 months to get your return filed. I had this happen last year. Okay, somebody ended up coming in like a day before the deadline. They ended up, hey, Ronnie, can you please file an extension for me? Yes, I'll file an extension for you. I get the extension done. Okay? Don't hear from him for months. Then we go through, and at the deadline, in October, we end up filing his tax return. He owed $25,000. All right, 1% a month times 6 months. I mean, he had a $1,500 penalty. So he was upset about it. He wanted me to pay the penalty. Because, he said usually somebody would have had me make an extension payment. Well, I didn't have any of his stuff. I mean, and so, what I want to emphasize is, I feel bad about that, but, take some ownership and some control over your tax situation, okay? Do not expect your accountant who's just ended up working, probably 60 to 80 hours a week over the last 3 months to be able to guess what your tax payment should have been the day before the deadline, okay? Have a little bit of consideration there. Take control of your own tax situation and provide that information, maybe a couple weeks ahead of time. In that case, I'm sure you'll be taken care of over and over again. All right, let's see. Sorry, thanks for bearing with me on this. I am kind of still getting over a cold, but I wanted to make sure to do the live stream with you today. All right, let's see. I have a property management company and they pay a contractor directly to fix repairs to my rental. Do I need to ask my property management company to give me a W-9 for this contractor to allow me to write off this expense? The property management company should be 1099ing everybody. But it would be smart to double check with them to see if they do. Okay? But typically I think they normally do. But like I said, make sure to double check with them if not. What else do we got? I am excited for tax season. This will be tax season. I believe it will be number 14 for me. I started in 2009, so this is number 14 for me. And I appreciate all my people that are with me. Al, feel free if you just go into like where you logged in. This will be the full replay will be there for you to click on. They're always there after Johnny edits them. And so he might have to edit out me coughing all over the place during some of this, but I just want to say that I appreciate everybody that is joined today. Prosperity Society is very much growing. I like some of the questions that were in here. I think some of the questions that we posed today are probably questions that I should be doing some videos on. But I hope you guys are finding prosperity to be valuable to you. And, we have 60 people now who are part of prosperity. So, when we get that number up to 60, I could see it continuing to climb and this community really kind of growing and helping each other out. I mean, even if you just look at some of the questions that we've had today, I promise these are things that, maybe I have not even thought about sharing with you guys. But then also some of the comments, like with Al jumping in and saying some things, I mean, that is what this community is going to be about, is just helping each other and thinking about things from different angles with people who have different experience. So, anyways, very grateful to continue to do this. I am going to jump off. Ray, I will shoot you. I see your last question, but I'll shoot you an answer to that. And I hope everybody's doing well. And feel free to reach out to me if you need anything. Thanks so much.